Hi, and welcome to Capital Grounds Podcast. I'm your co-host, Nick Miller. I've got my co-host here, Joe Fisher. How are you this morning, Joe?
Good, Nick. How you doing?
I'm doing well. I'm doing well. It's another beautiful day.
It is,
So
yeah.
glad to
But
be here.
getting warmer down here in Texas, that's for sure.
Yeah, it was pretty cool down there last weekend. I was down there for a short trip, and yeah, lots of rain. I don't know if you guys got rain, but Western Texas did.
Yeah, so yeah, we did, and I would say it's been unseasonably cool, but we're starting to warm up. My wife just let me know I think we should hit 90 later this week, so
Oof,
looking forward
wow.
to it.
I guess somebody has to, but
Yeah.
well, good. For our listeners that aren't aware, don't know, Joe and I are with SITG Capital, and this morning we're bringing you some news about general real estate markets, talking about
Yeah.
multifamily real estate specifically. If you haven't checked out our website, check us out at sitgcapital.com.
hmm
But Joe, let's dig in. What's
Yeah.
going on? We've got a lot of big news going on. Financial
A lot of
markets are in a lot of
lot of big
turmoil.
news. A lot of big news for sure. But first let's talk about coffee a little bit and
Mm.
I got a mug here for you today, Nick. This is my Steamboat Springs mug.
Oh, I love
Uh
it.
I love the shape of it. I love the colors, everything about it. And Steamboat's a great place to go if you guys haven't been. So we like to get mugs when we travel, just to remind us of that place when you get up in the morning, get a nice cup of coffee going. I will say, you know, as far as coffee goes, I think we talked last time about Cuban coffee. Some great Cuban coffee I had down in Florida. I'm missing that a little bit, but we do have a great local coffee shop here where I'm at in Dallas, in one of the neighborhoods we're developing in. It's called Full City Rooster. And Nick, I'm looking forward to taking you there next time you're down here because they do a really good job. Actually, their primary function is roasting. Uh,
Mm.
they do a lot of roasting and shipping the beans out and everything. But they've got a great little shop and they've got some really good coffee. So I'm looking forward to taking you there and letting you experience that.
Yeah, that sounds great. That sounds great. I don't think we have our next trip on the books quite yet, but I know we're going to be at least trip down to Texas, but
Yeah, well, we
we'll
do
be
have New
looking
York
forward to
coming
it.
up, so
We do
we're looking
next
forward to
week.
New York, and man, we can find some good coffee in New York. I know that, so we'll keep you guys updated on that.
Yeah, looking forward to getting a mug too. It'll be my
Yeah.
first trip to New York City, so I'm ready to be shell shocked, but looking forward to it for sure.
Yeah. Yeah. Well, I think the first thing we wanted to cover, because it's pretty big news, is the First Republic failure that just happened. So for those of you that don't know, and I'm sure you probably have heard, but it's actually the second largest bank failure in U.S. history. So we've now had three of the four largest bank failures in U.S. history have occurred in basically the last 3 months.
Yeah.
So it's a really, people use this word all the time, but it's an unprecedented time. There's a lot of uncertainty out there, and some of these issues, Nick, and we talked a little bit about this, aren't necessarily because these banks don't have the liquidity.
You're right. You're right. Fractional reserve banking, if you're not aware as a listener, is where banks are required to keep a certain amount of deposits on hand relative to the
Mhm.
amount that they lend out. And in a situation like we saw with SVB, there are sometimes instances where they have people looking to withdraw more money than they have on hand. And so they have
Right.
to liquidate some of their assets to make that cash available. And at least in the instance of Silicon Valley Bank, uh, Joe, I think you and I were talking about this earlier.
Yeah,
They
right.
they had the liquidity. They had the
They had it.
liquidity, and
They
it
did.
was,
They had
yeah,
20 billion at JP Morgan, and they had called that afternoon Uh, and I can't remember the date that, this all happened, but that afternoon
Would have
they
been
called JP
Wednesday.
Morgan, yeah, to
Yeah,
wire the
Wednesday.
funds over to them, to fulfill all of their requests. And JP Morgan said, well, hey, it's after the Fed wire cutoff time, which I think it's 4 o'clock Eastern. This is, 1 or 2 o'clock Pacific time. And anyways, they worked out a deal. President SVB got on the phone with President JP Morgan. They figured they could push it through. So they went to push it through. Fed came back and said, hey, you can't send 20 billion all in one swipe. You got to do a test first. So they did a test. And by the time the test was done to send the full amount, the Fed said, I'm sorry, the window's closed. And how that works is once you can't fulfill, it's an automatic thing. The Fed comes in and seizes the bank. So they actually had the liquidity. They could have made it through it. And to Nick's point about, what they were showing on the balance sheet, that was all paper losses until they actually had to realize it. And then they actually did have to realize it because the Fed seized them for that reason. So we've got these rules in place to protect us from another 2008, 2009, but now these rules are kind of hurting us in some ways, or at least hurting some of the financial institutions that aren't quite as prepared, maybe as they should be.
Absolutely. And you hear a lot about, there's that word absolutely. It's my favorite word in these podcasts, but
It's a key word if you guys didn't know.
it is, yeah, it is. Uh, but what's frustrating to me
Mhm.
is that when we look at these paper losses, a lot of them are in debt securities, right? There's a large
Yeah,
chunk of treasury losses that these banks hold. And the stickler, the really frustrating piece is that, the beauty of treasuries are that if you hold them to maturity, you're going to get your principal back,
right.
right? So the
Exactly.
paper losses, what you've got on paper as a loss isn't really
Hmm.
valuable or important because assuming you hold it to maturity, you're going to get your principal back and you're going to be in the clear. But,
Yep.
because of these rules that we have in place, these banks have been forced to liquidate some of these assets at a loss, and then, the snowball starts to roll downhill. So it's
Yeah,
frustrating.
it is. And, I think we see a lot of parallels in real estate, which is kind of a good segue into the bulk of what we're going to be talking about today, which is, you have a lot of debt that's coming up that's going to need to be refinanced. And you have maybe operators that are doing an okay job. They're servicing their debt right now, but they may not be able to once they're forced to refinance. So there's some parallels there where you may have bought it at a higher price than what it's worth now, but it's okay because it's a paper loss, right? But you're going to get forced to kind of realize that, and you're going to get forced to move forward into a different type of debt if there's anybody out there that's lending. And so it's making it a really difficult time for real estate in general. And so one thing, Nick, I think we thought this was interesting, is kind of how we can illustrate it really with one company, what's going on in the market with Blackstone. Um, so they've got a couple of funds. They just closed a fund that they raised a little over 30 billion for, and then they've got another
Largest in
fund.
history. Yeah.
Yeah, exactly. And they've got another fund that they're actually limiting redemptions on.
For the
So
sixth straight month.
right. So the question is why? Why is there this push and pull kind of happening?
Yeah, I think what I love about finance in general, and and for those that crunch the correct numbers and can take the appropriate risks, we're in an opportunity, and quickly approaching, I think, a better opportunity even,
Hmm.
where you've got some of these paper losses in your books. Maybe you hold some of these properties that are worth less than what you paid them for. But we're seeing this in a number of places where you've got firms that are comfortable and actually interested in selling these properties at a loss
Right.
because that'll free up their capital, free up their balance sheet a bit, where they can go out and when you know things continue to get worse, when stuff hits the
Right.
fan, you're going to be able to go in there and purchase properties at all-time lows. I mean, we're seeing
Yeah.
this, you know, in the commercial real estate space where you've got some properties. I was reading an article earlier about property in New York, $300 million property that is now, you know, under fire sale and
Hmm.
could go for as much as 80% less
Yep.
than, you know, what the value was just in recent history. So
Yeah.
yeah, if you can free up that capital and deploy it on a much better deal, you know, there's potential value there. There's potential value there, but
Right.
it goes against what a lot of maybe outsiders might think.
Well, I think you got to understand the market dynamics, and I think Blackstone does, right? And to your point, Nick, I just this last weekend we met with somebody that we don't work directly with in the real estate industry, more of a peer type of situation, and we talked with him about what he's doing, and he's more in office space, and he said that exact thing. He said, "Look, if I have $100 million in property, I can get 70 million for them right now. I'll take it." Because I believe that I'm going to be able to opportunistically buy using that 70 million over the next year or so, because there's going to be a lot of stuff coming down the line. And that's just the general sentiment around. And I think that's what Blackstone's kind of, preaching here. The reason that they're limiting withdrawals for their fund that has been established for a while is because they don't have the liquidity to fulfill, the requests that are coming in, right? So that's the one reason. So that in a sense is struggling, right? But then they raised even more money to have another real estate fund. And why is that? Because they understand that there's going to be a lot of opportunity coming up over the next, few months, year. It might even last 2 years. We don't know. But I'll say this, most people that I talk to in the industry are saying this is going to be the best buying opportunity that we've seen since the financial crisis, specifically in commercial real estate. But this will be the best buying opportunity that we've seen in, what is that now, 15 years, Nick? So I think a lot of people want to position themselves to be able to take advantage of that. And we can see it in what some of these big firms are doing, like Blackstone.
I completely agree. I completely agree. And Joe, you know, this runs counter almost to what you and
Mm-hmm.
I have been preaching to clients on the advice side, you know, before we moved over to real estate. It goes counter to what we were preaching to clients for years, right? You know, where you just have to weather the storm and stay in the market. You know, time in the market is better than timing the market. But this is a different, you know, completely different scenario, and it makes a lot more sense in a lot of these instances, because with the way that we structure debt on a lot of these deals, we are
Mm-hmm.
kind of beholden to banks, right? The
Right.
lenders have a lot of control over us. And if you're able to absolve yourself of those debts, sell a property, take that cash, and then, you know, prepare it for some of these better opportunities, there's a lot of value to be created.
Yeah, you're right. There's a ton of value to be created. And again, I think this is going to be a really good buying opportunity. So if you can position yourself the right way to be able to take advantage of that, I think it's really going to benefit you long term. And we're seeing everybody who can start to do that, start to position themselves appropriately for what's ahead. And you guys got to remember, real estate's a slower cycle, right? So I don't want to say it's easier to see things coming, but remember we talked about that foreclosure that finally came down. What was it, 2 months ago? But finally came
Mhm.
down. We had been talking about that for a long time. We saw it. We knew it was coming at some point. So with real estate, it's a bit different than the stock market. The stock market is always going to react much quicker, and it's always a forward-looking indicator, right? So the stock market now is going to price in, what they think is going to happen 6 months from now or whatever it may be. Real estate, because of the debt cycle, there's a lot of lagging indicators that are happening in the real estate
Much
market.
more. Yeah.
Yeah. And it's just a slower cycle. So you can see, hey, we know all of these buildings are coming up for refinance, and we know that not all of them are going to get refinanced where they need to be. So we understand that there is going to be a buying opportunity potentially if you can position yourself to be able to buy those at the right price with debt available to you, with the right lending partners. And that's another key. It's hard to find good lending partners right now because of everything that's going on in the banking industry.
With all that being said, if you are an individual investor who's looking to get into real estate, maybe you're looking to, have more of a do-it-yourself attitude or looking to get
Hmm.
your hands a bit dirtier. Maybe you're not quite an accredited investor or something of that nature. I'll tell you, at least here in the Kansas City metro area, Joe, we've got a lot of multifamily properties on the small side from small investors or small firms that are up for sale. And it's now is the time. If you could look back, like you talked about earlier, if you could look back
Hmm.
15 years and look at the financial crisis of 08, 09, if you had the capital available at that time,
Yeah.
you could make a lot of money. You could build a lot of wealth with some of the deals that you could get your hands on back then. And
Right.
all that's
Right.
to say, we're talking about a lot of turmoil in the markets as a
Hmm.
whole. There's still a lot of stuff, a lot of work being done in the markets that we participate in. The DFW area is still continuing to grow. Joe, we were talking about some of the big corporations that are moving in your neck of the woods and in
Yeah.
some of these other areas.
Yeah. And see, that's the interesting thing. I mean, people are saying office space is dead, right? Or office space is really going to struggle. And I think that's true to a point. It depends on the market, though. Nick was mentioning, a building in New York. I've seen some office buildings in San Francisco, same idea, 75, 80% off because, they're not getting filled and they can't service the debt. All of these things, it all ties in together, right? But DFW, as an example, we have, I think, 6 million square feet of office space under construction, which is quite a bit for DFW. And the key to that, though, is that we have a lot of big tenants that are taking up these new office spaces. So Wells Fargo is taking 850,000 square feet. I think Goldman Sachs is taking 800,000 square feet. Uh, there's, Christie's Health Systems taking 450,000 square feet. So there's the the difference between what you're seeing in some of the failures and what you're seeing in some of the successes is the successes have big tenants that are still committed to office space and agreeing to take large chunks of that office space in desirable areas. But they all want new, they all want Class A, they all want more collaborative type of environments than maybe what we saw in some of these older builds from the 80s that are more traditional office space, if that makes sense.
It does. It does. And, that's not to say that the DFW may not see some sort of retraction, a couple of decades from now. But, I mean, look at New York. New York has
Yeah.
is boomed. Now they're starting to retract a bit. We're seeing this at least in the office space, the commercial office space markets and LA, same scenario. But as DFW continues to grow, we're going to be there and
Hmm.
continue to take advantage of these opportunities
Exactly.
until the tides
Yeah.
turn, and then we'll move on. We'll continue to manage what we can, but we're always looking for those next growth cities.
Yeah. And it's not just DFW down here, it's Austin too. I was talking
Oh yeah.
to a pretty prominent investor over the weekend, and he was telling me to him, Austin's the next Hong Kong, right? Uh, that was his take on it. And
Wow.
we were just going over numbers there, and it really is crazy the multiples that Austin has for what it is. I mean, he was giving an example of buying a piece of property for $100 million, and if you built the right building, you would come out with a very significant profit just because you can you can demand such a high uh, cost per square foot in Austin. So there's a lot of markets that are still good to be in. Does it mean that there's not going to be some trouble, or there's not going to be specific properties that have trouble, or even specific investment companies that have trouble over the next year or so? No, it doesn't mean that. That you can have weakness in these markets, but they can still be strong markets.
Opportunity abounds. I think I saw recently the Wall Street Journal listed Austin is number 2,
Hmm.
and I think Dallas is number 4 of the hottest job markets in the U.S.
Yeah, that
Um,
plays a big role. Yeah,
it does, and as long as those continue, we're going to be there to take advantage of it.
yeah, absolutely. But, let us know where you're at, if the market that you're in, if you feel like it's a good market, what you're seeing there. There's a lot of opportunity out there in general. And I think, kind of the point that we're trying to make here is, if you invest soon, you're going to be in a much better position a few years from now than you are today, just because there's opportunity coming and we can see it, and we want to take advantage of it, and we want you all to take advantage of it as well.
That's the beauty of investing, right? Building wealth for tomorrow. And, if you can make the numbers work today, you know, best to get it done while you can. But
Yes.
Joe, I appreciate your time this morning. Any other
Thanks, Nick.
thoughts while we've got each other here?
I mean, just the normal spiel, guys. If you can, check out our website, sitgcapital.com. If
Mhm.
you can subscribe to us on Apple Podcasts, Spotify, we put the videos up on
YouTube,
YouTube.
yeah.
Yeah, if you wanna ask us questions, you can email us. We will be in New York next week for a family office conference. So if you're out and about, you want to say hi, get some coffee with us, let us know. We try to be open guys, and we want to give as many people access to a good investment as we possibly can, because we do believe it changes lives, and it creates more stability for your family, and creates income that you can live off of in the future. So we believe in it, and if you got questions, please reach out.
Send us an email, comment,
Yep.
give us a call, whatever it takes. We'd love to hear from you. All right. Well, Joe, I appreciate your time this morning. Good to connect. Looking forward
Thank you,
to,
Nick.
yeah, seeing you next week in New York. And we'll talk again here soon.
Sounds good. Thanks.
All right. We'll see you. Take care. Bye bye.